Welcome to Kitco News. I'm Niels Christensen. Gold prices pushed to record highs in August. So now the question is, what happens for the rest of the year and going forward? Here to talk about the gold price and where to find value in the mining sector is Rondald Stöferle, portfolio manager at Incrementum and author of the incredible In Gold We Trust report, which came out in May this year. Ronnie, it's been a busy summer for you. Thank you very much for joining us today.
Hi, Niels. Hi, how are you?
Good. It's always a pleasure to have you on the show. The first question I want to ask, have we seen the peak in gold? What's going to drive gold prices back above $2,000 an ounce, by year end?
For me, it's pretty obvious we're in a stealth bull market in gold. Now, what are the reasons for that? First of all, we're seeing that gold is rising in every currency. Gold is up 27% in US dollar terms. We're seeing that silver is outperforming gold. So silver is up almost 50% since the beginning of the year. So the gold-silver ratio falling is a great confirmation for the strength of gold. Then we're seeing that actually the mining equities do outperform the price of gold itself. So we're seeing outperformance from the large caps versus gold. We're seeing the juniors outperforming the seniors. Those are all confirmations. Now, of course, we saw that when gold went over 2,000, everybody was writing about gold and sentiment felt a bit too positive. And then we came down, but it seems that there's so much capital waiting on the sidelines at the moment that we just don't see any deeper correction. Can gold go to 1,800, 1,850? Of course, but it is just normal and healthy within the course of this bull market to take a breather. And I think, Niels, September is, from a seasonal perspective, one of the very best months for gold. And I think we can easily go to 2,200 or even higher until the end of the year. But picking those numbers, that's always always hard. But as an analyst, you kind of have to do. But I think that the important message is we are in a stealth bull market, and I think this party has only just begun. And we're seeing, and this is really the most important driver going forward, we're seeing that institutional demand is coming back. And I think this is really what's going to move the price of gold.
Well, that was actually going to be my next question. I mean, what drives gold? I mean, we've, especially in the last maybe couple weeks, we've seen people talk about the inflation, real interest rates. What drives gold from here? Is it the fact that the Fed is going to keep rates? I mean, we've seen them change their inflation target to an average of 2% now. Is that what drives gold from now on? Is that inflation pressure?
Well, I mean, what the Fed told us over the last couple of weeks is low rates forever. I think we won't see rising rates until 2023 at the earliest, but I think, we won't see positive real interest rates over the next couple of years. And this is the most important driver from my point of view, from a fundamental point of view. Then I think that the tolerance of the Federal Reserve for an overshooting of inflation, that's another very, very important thing. And just look at inflation-sensitive assets. And we're currently writing a special report about inflation and even about stagflation. Inflation-sensitive assets like tips, but also, of course, gold, silver, the commodity space, they're all rising pretty strongly in the last couple of months. So I think the market is already telling us, be careful, inflation is on the horizon. And that's actually, what the Federal Reserve and central bankers and politicians want. So you could say that gold investors and mining investors are basically sitting in the same boat like central bankers, which feels a bit odd. But I think this is really happening. So I think that portfolio managers should really allocate their portfolios for rising inflation. And let's face it, the average investment manager nowadays is, I think, 52 years old. So they have never experienced a period of long, strong inflation or even stagflation. So I think this will catch many investors on the wrong foot, and at the moment, 0.5% of all assets are invested in gold. So basically, there's no allocation at the moment, and this will change. And I think really this year, this marked the beginning of this so-called public participation phase.
It's interesting that you talk about inflation. I mean, you have been following inflation very, very closely. You guys actually have probably the coolest inflation gauge in the market, the gold beer ratio. What's this telling you?
Well, I mean, this ratio is just telling you that the inflation rate at the Oktoberfest in Munich is significantly higher than the official inflation rates that are calculated by CPI, PCE, and all those government statistics. And it's just a great a statistic that tells you that gold is over the long term really preserving your purchasing power. And I think this is what gold is all about. Gold is there to protect your purchasing power over long periods. It is not there to make you rich. And I think that with inflation being really what central bankers, but also politicians really want to see and want to achieve, I think that many investors will have to consider what's the best inflation hedge out there. And I think that gold really made a pretty solid case over the last couple of decades, but over the last couple of centuries. So this is basically to tell investors, because we saw that in the gold industry, there's a very high correlation between gold bugs and beer drinkers. So we came up with that comparison. But we also got many other comparisons just to show how gold is preserving your purchasing power.
So where's the sweet spot for gold allocation? We hear, the average is between 5 and 10%, but I'm sort of wondering if gold is in this bull market, should you be sort of more overweight, closer to the 10% or even above the 10% allocation?
Well, we crunched the numbers and we came to a rule of thumb between 8 to 10%. But I think it doesn't make any sense to stick to those numbers, because it just depends on the rest of your portfolio. It depends on your price, time preference. It depends on your risk preference and so on. But I think if you believe that inflation will become a concern, if you think that rates or real rates will stay very low, if you believe that at some point we will have to deal with our debt, then I think you should have a pretty high allocation to gold and also the mining space. So we should not forget, at the moment, it is not about liquidity. It is all about excess liquidity. And now we're seeing M2 growing at 24% and M1 growing at 40%. We have never seen those numbers in the 1970s. So I think this combination of aggressive monetary stimulus and aggressive fiscal stimulus will really be one of the most important drivers going forward, and will at some point really push inflation rates significantly higher.
Okay, so now let's move from the gold space into the mining space. Where do you see value in the mining space today?
Well, we see lots of value in the mining space still, actually. I think that, if you have a long-term view again, the great gold analysts called Guns N' Roses, they once said, all we need is just a little patience. And I think that, as a gold investor, you really had to show lots of patience. But companies, they really did their homework over the last couple of years, and now they're harvesting. Now, as a shareholder, we're getting dividend growth. We're seeing that margins are extremely high. We're seeing that price cash flow for the producers is basically at the lowest level in 30 years. We're seeing price EBITDA being at extremely low levels. We have seen M&A activities that really made sense. So we're far away from that environment that we saw back in the days in the last bull market. And we shouldn't forget, Niels, the HUY, the gold bucks index, is currently trading at 340. It was trading at 627, I think was the all-time high in late summer 2011, when gold was trading at the same level, basically at 1900. So I think mining companies now being really on a much more solid foundation and now really caring about their shareholders, and the price of gold being at the beginning of a really stealth bull market with public participation entering, with institutional demand entering, I see a tremendous amount of value in the space. However, we should not forget, I mean, some financing deals that come into my inbox makes me a bit concerned. So I think there's lots of crappy deals out there at the moment at I would say ambitious valuations. So as an investor, you really have to do your homework more than ever. But there are great exploration stories out there. I think there's great development stories out there. I see tremendous value, especially in the silver space. Our assumption has always been that in the course of a gold bull market, silver should outperform, and we're seeing the beginning of this. So I think we should follow the silver space very closely. So I think going forward, it's a great sector, and we should not forget there's a great by Wood Mackenzie that just came out. And they said that the gold industry must spend $37 billion over the next 4 years to keep production flat. So from my point of view, we will see M&A activity picking up again going forward. And in our portfolios, we've got some great companies that at some point, I think they will be taken over, but at significantly higher prices.
Ronnie, thank you very much for your time. I do believe you're the first guest to quote Guns N' Roses on the show, but I just wanted to thank you for your thoughts on the gold market and the mining sector, and the fact that investors should still use caution even though we're still in the early stages of a bull market.
Absolutely. Thank you very much, Niels. I really enjoyed that.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.